freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Adam, how are you doing today?
Today's good. I've been enjoying the cool down here in Northern California. It's no longer 100 degrees. Just got back from Tahoe this weekend, which was gorgeous. I was sending you pictures of the water. It's always so astonishing up in Tahoe. Did
you go out on the water, or were you just looking out over it?
We didn't take a boat out, but I went like loosely swimming. I say loosely because I didn't ever like fully dunk, but there was a bunch of rocks. I was kind of sitting on rocks and like wading through kind of like some shallow sand stuff. But it was fun. And then we did a hike the second morning. My girlfriend's an artist, and she'd been taking videos for her social media, and she was like, I wish I could get a video of the rocks and the water, but it's too like rapidy. And I was like, well, just put your phone under the water and take a video. She's like, I'm not doing that with my phone. I'm like, well, mine's a brand new Pixel. It's just, I don't mind dunking it. So we got some pretty cool videos of it, like kind of like you saw the water underneath, and then it'd be like where the camera cut off, there'd be like a pink flash when it goes through the water, and then you'd see the above in the trees. So
that's cool videos. Very nice. I definitely want to get out to Tahoe sometime. You and I, whenever I eventually make it out there, we'll have to go, because I've always heard amazing things and known lots of people that have gone, and some people that live there, and I don't know, never actually gotten to see it for myself. It's beautiful.
It's beautiful.
Part of the world.
Yeah.
That makes a great segue into our topic for today. Not really. There's no connection whatsoever. But Adam had this great idea for a new series that we can start. We are starting. Today's the first day of this. We're titling it very originally, No Investor Left Behind. We're just going to cover some things, misconceptions and terms and some other stuff that I think we probably take for granted because we work in this space every day. But we think, well, these are some maybe basic concepts and things that everybody knows, but then we realize that it's not common knowledge and it's not something everybody knows. And we want to make sure that as we talk about different concepts and different ideas for investing in commercial real estate and all these things on the show, that we're not just glossing over important concepts and leaving investors behind. So that's kind of the objective with this new series. We're thinking we'll probably do one of these once a month or something like that. Just hit on different topics. So if there is anything that you would like to hear, definitely write in. We've got a contact page on the website at wealthindependencepod.com. And this would also be a great time to remind you, if you are enjoying this, you enjoy the No Investor Left Behind series, leave us a review on your preferred platform, whether it's YouTube. Leave a comment, like the video, like the channel, subscribe to the channel, all the wonderful things, and Apple and Spotify and all the places. Let the computers know that you're enjoying what you're hearing, and we'll get the message out to more people. But with that, we'll dive into the first No Investor Left Behind topic that we've got. And I don't know, Adam, you want to kick this one off?
Yeah. So today we're going to talk about cap rates, which is the long drawn out version of that is a capitalization rate. And I think where we really want to start with that is another term, which we won't do a whole episode on, but it's NOI. And NOI is net operating income. That's basically your income backing out your debt services. So, if you've got a building that makes $1,000 net a month, but you're paying $1,000 in mortgage, and you're counting that into your above line stuff, you back that out. So now maybe your building's making $2,000 in net operating income. And one of the reasons you do that is if you're trying to standardize the way you're looking at a building, and if you were to go sell it to someone or someone else was buying it, or you were going to refinance, the current debt doesn't really matter, right? Whatever this other person's getting is going to matter a lot more. So you back out the debt service.
Yeah, and because this will make sense as we continue explaining cap rates, but NOI is really it's one of the primary valuation. It is the primary valuation driver in commercial real estate, and so we'll dive into this a little bit more, but commercial real estate's not valued like residential, where residential is valued based on comps. Commercial is valued based on a multiple of that NOI, which is the cap rate. Again, we'll dive more into this, but so when the reason you back out expenses that basically you kind of envision. You're like, are there any expenses as far as owning this property that a new owner would not have? Then those kind of get dropped off. Those aren't considered part of NOI. And typically that's going to be the mortgage. Usually that's the only thing. But there might be some like entity level type taxes, some things from maybe the way that they've set up the ownership structure that are specific to the ownership of the asset and not the operation of the asset. Those would not be included in NOI either. But these would typically be, electricity, gas, other utilities, maintenance, what am I for? All the things I'm trying to
all
go
the
through
regular
a
expenses would be factored into it. And really what this is driving towards is what is your on-levered return, right?
Yep.
And that's what a cap rate is. It's your
Yep.
your on-levered return. So if you have a building that is producing, the reason you back out the debt is you're kind of looking at the purchase price and then the NOI, and that will drive your cap rate. And there's two different kind of types of cap rate, and we'll go into how some of the things are calculated here in a little bit. But there's the market cap rate, which is similar to when you look at an appraisal on a single family home. And you're like, well, my house is a 3-bedroom, 2-bath, 1,200 square foot home, and the neighbor's is a 3-bedroom, 2-bath, 1,200 square foot home. And that one sold for $500,000. So mine's probably worth $500,000. It's a comparable approach. And you'll do a similar thing in multifamily, but what you'll normally look at is what are the comparable cap rates of what's selling, right? So if you have a building that sold and it had, the income was, or the building was a $100,000 building, it's cheap for multifamily, but keep the numbers small, $100,000 building, and it was making $8,000 of NOI, that building sold at an 8 cap. So that's kind of the market. So then you do that a handful of times and you'll get a market cap rate, right? You're looking at, well, what have other things that are similar sold? Doesn't mean that the building that you're looking at buying is going to sell at an 8 cap. It might sell at a 9. It might sell at a 5. Every building's a little different. Just like every property, single family home that you're buying is different, right? Why did that one house on the street sell for $300,000 more than everything else? It was bigger, it was nicer, it had better finishes, it had a brand new roof, it was built this year, right? All those little things change the way that those individual properties sell. And so, do you want to jump in?
Just the one thing I'll add there, the big difference is in single family where you look at a value, a comparable value, right? A dollar amount. In multifamily or in commercial, when you're not looking for, this is a similar, this building is similar, it's roughly the same size, same condition, was built around the same time, similar type location. You don't look at the dollar value that it sold for. To Adam's point, you look at the cap rate that it sold for, which of course is a factor of its NOI. So that can kind of take into account a building that is a comparable building, but maybe its expenses are really high, which makes the NOI low. There's operational things. It kind of factors in all of those things. You get a market cap rate. And so that, again, there's variances to this, but that's sort of the thing where it can be hard to overcome a market cap rate like that again, it tends to be set by the market. It's associated with risk. The lower the risk, the lower the cap rate, which also means the lower the return. But and then so the big driver, not to get too far ahead here, but the big driver then in determining value is being able to push NOI. If you can't really control cap rates, which you can't, we can calculate a specific building's cap rate, but the market cap rate is really driven by the market, just like comparable values in single family are driven by what others have sold for. And this is where the key difference between single family and commercial, where you can't really control the comparable value. You can't really, in commercial, you can't necessarily control the cap rate too much, but you do have a lot of control over NOI. And so you can grow NOI to increase the value of the building, even if you can't directly influence the cap rate.
One thing, and one thing that when I was first learning about cap rates and commercial valuations, and just kind of restate what you just said, but in a different way, is a lot of times the cap rate's going to be, what does someone want to earn off of that building, right? So if I have $100,000 and I want to earn an 8% return, let's just say I am the market, right? And I want to earn an 8% return on the building, then that building that or $100,000 I'm willing to pay for needs to produce out $8,000 a year of income. That's my return, 8% unlevered return, no debt, nothing like that. And a lot of times, I'll add one more thing here, is that you'll find the market cap cap rate tends to move fairly in accordance with the debt. A lot of times your market cap rate will be a point higher than 1% higher than your current going debt costs. And that's where you see a lot of values change, right? And you can see a compressing cap rate or an expanding cap rate. And we'll dive into that. And then I think we'll go into a few examples about, how this plays out in reality. But if you're in a market where, and like we saw from 2019 to 2022, we saw interest rates just going down and down and down and down and down, you also tended to see cap rates compressing, right? And so if you had you were in a market in 2019 where the cap rate was 8%, and in 2022 the cap rate was 4%, your same building making the same amount of income is double its value. And the reverse is true, right? If you bought a building in 2022 that had doubled its value since 2019, and this is where we saw a lot of people get really hurt and lose a lot of money, if it goes back to 2025 with a market cap rate, let's say, is roughly 8 again, your building just got cut in half back down to that 2019 number. And so
without any change in NOI.
No, you could have actually increased your NOI by 10% a year, whatever your business plan was, and you could still be underwater on the building.
Yep. That's the power of cap rates. And I feel like we've talked about this in a lot of different ways. This is kind of confusing. I mean, cap rates, I feel like, are one of maybe the more harder things when you haven't been exposed to this. It's because there's several different ways to look at it and to consider a cap rate and what can, again, the difference between what your actual cap rate of a property that you bought, which is effectively, it's, as Adam said, it's your unlevered return, versus the market cap rate, and what the difference between those are. And you talk about a going in cap rate and an exit cap rate, and there's all sorts of things here. I think the bigger takeaway from this is this, maybe we are starting here this series with one of the more complicated things, but it's arguably the most important number in commercial real estate, because the values really get driven by this, and everything revolves around a cap rate. And it's just a very important concept to start to learn early on if you're going to understand how changes in value, or how changes in net operating income impact the value of a property.
And I think with that, we can dive into a brief example, and I'll stick with my $100,000 building and $8,000 NOI, right? So let's just say you went in, you bought this building, your going in cap rate was 8%, right? Because based off of where you bought it, you paid $100,000, and you made $8,000 a year of NOI. Okay, well, now let's say that the market goes down, right? Like we had said, to a 4% cap rate. Well, now your building's worth $200,000.
The market has gone up, meaning the cap rates go down. Yeah. Cap rate fell, and it increases the value, right? Because people are expecting less of a return on their money. So if you get down to a 4% cap rate, your building's double. The other way to do that, because we're not do the math on that just to make sure. So basically
$8,000 over 4%.
Correct. Yep. Yeah. So you would divide 8,000 by 4%, and that now gives the new value, which is $200,000. Meaning, if you originally paid $100,000, again, no change in the NOI here. The only lever that has been moved in this is the cap rate. And by the cap rate decreasing, like getting cut in half, the value of this property has now doubled. So again, just wanted to make sure to fully explain that.
Super, super helpful. And then the second part of that is, if we go all the way back to the beginning of the story, right, where you have a $100,000 building and an $8,000 NOI, you buy it, and you're able to decrease expenses a little bit. Let's call it $1,000 a year. You're able to bump the rents a little bit. Let's call it $1,000 a year. I need to add something else because Dustin didn't want me to use $10,000 as an example here, because there's too many ones and zeros. So let's add another $2,000 if you just magically made the building better. So now you're up to $12,000 a year of income. If you're up to $12,000 a year of income, this isn't really the cap rate, but the return on that building is 12%, right? On the 100,000 you did, right? So you're making 12, but the market, let's just say it didn't change, is still at 8%. Meaning that you're making more than the market. Your return on equity, or your return on your initial purchase price, is higher than what the market's willing to pay. higher return, meaning it's more valuable, right? So if the market's willing to pay 8, once again, you do that $12,000 NOI divided by 8%, and it's worth $150,000. This is where it gets really powerful, right? I mean, that's a large increase. That's a 50% increase in NOI. But this is where it's super powerful, because now if you combine that with debt, which most of the time we do, even at a 50% loan to value on your purchase there, you paid $100,000 for a building, you got a $50,000 loan, you put $50,000 down, you added $4,000 to the NOI. For anyone who's not still lost here, you're left with a building worth $150,000. If you sold it, you pay off your debt for $50,000 and you're left with $100,000. So you doubled your money just by increasing the NOI, the net operating income.
Yeah, by 50%.
By 50%. So, I mean, it's a big increase,
Yeah.
but it's not huge. So a lot of times when we see these buildings and you see, rents are below market or their expenses are too high, you're able to really go in and do some of these value add plays. The things that I love the most, and I'll do this on my calculator really quick, is we just bought a building and we charged utilities back to the tenant. We charged them $45 per month per unit. So 45 times 12 months times 20 units, $10,800. There's not going to be any more expenses on our books to bill that out, right? It was just something we added to the software. So it's $10,000 more a unit. Our market cap here is about a 6.5% cap rate.
Sorry, not 10,000 a unit, 10,000 a year.
10,000 a year, sorry, 10,800 a year at a 6.5 cap rate in the market means we added $166,000 of value to the building. Once
Just
again,
from that one change.
We've got to sell it. There's all these things, right? But that's the power of NOI, right? On a building that we paid $400,000, $500,000 down on day one, we added $10,000 of NOI. Obviously, we've got to get that for 12 months. We've got to show it on T12s. I mean, it's not just tomorrow we get a check, but we've added $160,000 of value, which I'm pretty sure is like a 23% return over 500,000, 33% return through one change.
This is, if you ever hear, and if you're not familiar with the term value add real estate, this is what value add is. It's literally adding value. This is forced appreciation. And this is the power, and why Adam and I both love commercial real estate so much, is because you can't do this in single family and buying single family homes. Sure, you could charge, if the market, it's fairly common for utilities to be charged back like this, and you're not, you buy a property that's not doing it. Yeah, it will add to your income, but it doesn't increase the value of a single house. Whereas here, because the value of commercial real estate is a function of NOI and cap rate, by increasing NOI, cap rates stay flat or don't move. All you've done is just increase the value of the property. So it's a very, very, very powerful concept.
And obviously, then it will help if the cap rates go down, or if the cap rates went up and you were in a spot where you had to refinance, you might have some buffer. All those things are valuable.
Yep.
The next thing that I think is important to understand is that same return I just said. Okay, on paper that was a 33% return. The other thing I could have done, if this was a pro forma and I was showing this to you as an investment, once again, we're not investment advisors. We're not soliciting anything here. We're explaining common topics. But if the pro forma showed that, hey, instead of adding RUBS, because that's hard, you don't want to talk to tenants. Tenants don't want to pay more money every month. That's beyond the scope of what we're capable of doing. If you wanted to just show a 33% return, well, maybe I just show that at year 5 when we sell this building, the cap rate's 5%. Right? That same 1.5% drop on the same NOI. I have to remember what our NOI is on that building, but let's just say it's roughly 100,000 over a 1% cap rate is, that can't be right. I did something wrong. Oh, that's a 1% cap rate. So I would just need to go. So 5 is a $2 million building. 6 is a $1.6 million building. That 1% change on cap rate on $100,000 NOI from 6 down to 5 is equivalent of like $340,000 of value. Yeah. So when you're looking at deals and if you're just doing a high level approach, do rents make sense? Do you think they can get to where they're trying to go in the next 5 years? do expenses make sense? And what's their cap rate that they're going to try to sell at? Are they going to try to sell at, and maybe they're not going to sell, maybe they're going to refinance or whatever, right? Our business plan is not normally to just go sell an asset after we spend 5 years getting to know it. But if you are buying it at a 6.5 cap, probably shouldn't be modeling that you're selling it at a 5. I'm not going to be mad or confused if you say you're selling it at a 6.5 cap. Okay, maybe it'll move. I'd be pretty happy to see that you said you're selling it at a 7 cap and it still makes sense. It means there's a 0.5% that it can move up and these numbers still work. Well, if it moves down 0.5%, everything gets a little better, right? If it's flat, it's still better than what you modeled. So all that to say it's a pretty powerful lever. When you're reviewing a deal, a lot of times people will go through and they'll look at all the expenses. I've had people say, wow, that trash is really expensive, or do you really think you're going to be able to keep rehab costs that low? My answer is normally, yeah. I mean, that's why I modeled it like that. But the second part is are you not concerned about where the cap rate's at, right? Like, do you think let's look at that. Let's spend a little bit of time and tweak the big numbers that move things. Interest rates, cap rates, all of that is going to change the way that these deals perform more than, not saying we don't need to have budgets in line, but trash is going to be what trash is going to be for us or the next person buying it, especially in California where there's one provider.
To kind of again, take another angle at this, I think the flip side of the power of cap rates are that this is a very easy way to manipulate projected returns. Because it can have such an outsized influence on what the potential future value of a property is. And so to Adam's point, if you're looking at a deal and they are projecting that the cap rate will compress significantly, but in, let's say, 5 years, that's a fairly short time frame. And the example he gave was a 1.5% decrease over 5 years, 1%. Maybe that's reasonable. But at the same time, what you have to recognize is the sponsor has absolutely no control over that. That is 100% a bet on where interest rates will be. That's all that is. And the reality there is, if the sponsor thinks that they are so good at predicting interest rates and so accurate, they really shouldn't be in multifamily. They should be trading bonds because you can make way more money predicting interest rates when you're trading bonds than buying value add multifamily for a lot less work, quite honestly. So this is a very, very important point for anyone that's looking at a deal, because it is very easy to make the final returns look really good by compressing the exit cap rate. And all it is a number on a spreadsheet that nobody knows whether or not it's going to be right or wrong. We can, again, make guesses based on the overall environment, but at the end of the day, it's a pure guess. And if you look at a deal and most of the returns are being driven by the appreciation that they would be captured at sale and is coming from a lowered cap rate from what it was purchased at, that's a pretty big red flag. And I think the better question at that point to be asking a sponsor is, hey, let's say cap rates stayed flat. What do the returns look like? Let's assume they went up by 50 basis points. What do the returns look like? Because then that will really show the actual operational performance of the deal.
And if it starts going underwater when they do that, that's a problem.
Exactly. And so asking those questions and understanding where it's going to, how the deal performs when that exit cap rate is changed will show, again, is this really a good deal with a lot of operational opportunity, or is this just a bunch of spreadsheet engineering that's going on and we've just changed a number somewhere on a spreadsheet to make the returns look good?
And I think to maybe close this out, unless you have other things to add, and you can add them after this, but we have one partner of ours who still uses a calculator to run apartment deals. He's got a little scientific financial calculator on his desk. And he's just going based off of flat cap rates, right? Maybe he'll move it up a little bit, but there's not this complicated spreadsheet. And so at the end of the day, he's working based off of a simple model. And I think at the end of the day, most simple models are really what is valuable for this.
Absolutely. Yep. So keep in mind, beware of compressing cap rates or a compressed exit cap rate anytime you're looking at a commercial real estate deal. Because again, if the sponsor believes they are so good at predicting where interest rates will be, then they are in the wrong career. Is the big takeaway there. This is a topic you can cover this from 100 different ways. Cap rates are fairly complex. There's a lot of moving parts to them, a lot of pieces. I think it took, even for me, it took a lot of exposure to this. And again, a lot of exposure of understanding the difference between a market cap rate and my going in cap rate. And if we wanted to calculate a cap rate right now, what is that? And what's the difference between that and a cash on cash return and some of these things. So if you have listened to this and maybe hopefully you don't feel more confused than you did, but if you do, then that at least means the wheels are turning. You're trying to engage the brain. So definitely do some more research. If there's more on this topic you'd like to hear from us, reach out. This was just meant to be a very high level survey, but we could probably spend multiple episodes talking about cap rates and things that Adam and I have seen in deals and some egregious spreadsheet engineering related to cap rates and things like that. So definitely reach out if there's more to this, or you got more questions. This is a very, very, as we said, it's probably the cap rate and NOI are the two big levers to pull in commercial real estate values. And so understanding how that plays into, as a passive investor, how it plays into your potential returns is critical anytime you're evaluating a deal. But with that, I guess we can call it wraps for this one. This was a strong starting point, I think, for the series. You got anything else, Adam?
No, I'm all good. I think this was a good one.
I think it was too. All right, everybody, we appreciate you listening. As always, we will catch you on the next one. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.